Hey guys, welcome to the Jay Martin Show. This is Jesse Day, temporarily filling in for Jay. I've got a great interview for you guys with Adrian Day. But before we dive in, as always, there's a link below this piece of content where you can subscribe to Jay's free weekly newsletter where he talks about how you can use psychology and the power of the mind to gain an edge in markets and in life. So definitely check it out. And now, without further ado, here's my interview with Adrian Day.
This is Jay Martin.
Today's guest is a financial author and the founder and president of Adrian Day Asset Management. Mr. Adrian Day, it's great to have you on the show.
Well, thank you very much for having me, and I see we share the last name. It's a great name.
Yes, yes, absolutely agree with you. So I want to start with gold, and you've mentioned that we are in the perfect environment for gold and gold stocks here in 2023. And we've been seeing a lot of turmoil recently, banks failing in the US, persistent inflation, war, geopolitical turmoil. Is this type of situation the perfect situation in which gold normally thrives?
Well, let's step back from that a second, if we may, before we get to today. I think there's a lot of misunderstanding about what exactly makes gold move. A lot of people think a higher inflation number automatically translates to higher real gold prices, which is not necessarily true. People also seem to think that lower interest rates is good for gold, therefore higher interest rates is bad, which is not quite as simple as that. And so despite higher inflation last year, and of course a war in Europe, as well as a shaky stock market, gold did not do too well in US dollar terms anyway last year. And there were reasons for that. So without getting into that, let's look at what does move gold and why I think this is a perfect time and opportunity. I said throughout last year that gold would move when the market came to appreciate or realize that the Fed and other central banks around the world would not be able to control inflation without causing a serious recession. And I think what happened last week, as we're talking last week, or let's say the last couple of weeks, demonstrates what I mean. Two things happened that were very, very significant. Number one, we had the three banks in the US, we forget about poor old Silvergate, but there were three banks in the US that went bankrupt, plus of course Credit Suisse essentially defaulted. And so that answers the question, or that gets to the point of, with interest rates rising so rapidly over such a short period of time, it is going to cause damage. And we started to see that damage last week. Anyone who thinks that those banks are the only financial institutions that are skating close to the edge and are in trouble, I think is delusional. The second thing that we saw last week, of course, was in response to that, we saw the Federal Reserve, the Swiss National Bank, even the Bank of England try to get in on the act, throw money at the problem. And that is what central banks do when there's a problem. They throw money at it. And in the space of 24 hours, the Federal Reserve undid basically half of all the QT that they did in the last year. And so those two things, number one, rising interest rates will cause damage. And secondly, the central bank's answer will be to ease up. Those two things produce the perfect opportunity for gold, in my view. And
So
we
where,
can, yeah, sorry.
yeah, I was just going to say, where do you see the Fed moving from here? Because obviously, as you mentioned, interest rates moved so high up so quickly, and a part of the side effect of that, or some would say the direct effect, is this pain we're currently seeing with the banking situation. Um, People are starting to lose confidence, and now, as you mentioned, they've erased a bunch of their QT, and now they're essentially doing a form of QE, although they wouldn't put it that way. They're saying it's not inflationary. The taxpayers are paying for it. Of course, I know better than to trust what central bankers say and rather watch what they do. But where do you see the Fed moving from here? Because it feels like they're between a rock and a hard place. Do you see their battle against inflation, Powell being the new incarnation of Paul Volcker and continuing to raise rates moving forward? Or do you think they're going to have to reconsider their policy over the course of 2023 now that we've seen some systemic cracks in the system, so to speak?
Yeah, my thinking, and of course these things all can change as circumstances change, but I think QT is out of the window. We can forget about QT. When it comes to raising rates, and let's not forget, but what the Fed did over the last 12 months, the Fed balance sheet got to almost 9 trillion, and at its low last year, and at its low, it still had not got down to 8.3 trillion. So less than 8% in 1 year, when the Fed balance sheet was less than 4 trillion just 3 years ago. So it was hardly an aggressive move to begin with. So QT, I think, QT is out the window. With regard to rates, Powell has continually emphasized higher for longer, higher for longer. I suspect that before the year's out, we'll go up a little bit perhaps, but higher for longer is his mantra. And certainly he is going to say that fighting inflation is his priority. The problem is, I think most economists would agree with this. The problem is that you cannot control inflation by interest rates unless you move interest rates above the rate of inflation. And in the US, even with the decline we've seen in the CPI to 6% and the increase in interest rates, we are still meaningfully below the prevailing rate of inflation. Now, you might argue, some might argue, well, CPI is coming down more, it's not a problem, blah, blah, blah. But nobody disputes the fact that to kill inflation by hiking rates, you have to get rates above inflation. And that's, of course, what Volcker did very, very dramatically in 1980, 79, 80. And that is what this Fed has not done. You started by saying they're between a rock and a hard place. They are in a very, very difficult position, untenable position. Now, it's a position of their own making, frankly. So, I don't think the history books will or should be kind to Ben Bernanke, Janet Yellen, and Jerome Powell that got us into this mess. But nonetheless, looking at where we are now, they are in a very difficult position because to raise rates, as you mentioned, from zero lower bound to 4.5 or whatever, that's in less than a year. It's the most aggressive interest rate hiking cycle ever. We forget rates were already double digit when Volcker came in. So you could argue this is more aggressive, a more aggressive pace than what Volcker did. Something somewhere is going to break. We already saw that last week. But I think it's delusional if we think that those are the only financial institutions, and it's not just banks, but insurance companies, pension funds, not to mention, companies in general. If we think they're the only entities, as Warren Buffett puts it, that were swimming naked, if those are the only entities that are on the edge, and higher interest rates or the same interest rates for longer are going to cause more problems. So anyway, but I think we're going to see, what I think we're going to see is the Fed hold rates for a longer period of time, but still below the rate of inflation. So my economic outlook basically is for stagflation. I think we're going to see persistent inflation, not necessarily double digit, but persistent inflation, 5, 6, 7%, and rates that are still high, but not high enough to kill inflation, but high enough to cause a recession.
So for your average investor out there, do you think holding physical gold is a sound strategy in a market environment like this? And I'm wondering about how you approach allocation to physical gold versus mining stocks. Do you think people should first have an allocation to bullion before they start speculating on the equities?
No, absolutely, absolutely. And I love the way you say speculating, because all equity investors are basically speculations, however conservative the company might be. Yeah, absolutely. And I look at bullion in a different way than I look at equities. I asked the question, what is the reason for making that investment? The reason for buying physical is an insurance, it's a hedge. And as with other types of insurance policies, you don't trade your insurance policy. Maybe as you get older and your need for insurance declines, you might sell it down, but you're not trading your insurance policy, nor are you necessarily trying to buy your insurance policy at the absolute best price imaginable. You don't say, well, my home policies are a little expensive now. I think I'll wait a year and see if I can get a better price. So insurance, you buy, price is less important, and you hold it. Equities, of course, are something different. With equities, you're trying to maximize your return commensurate with the risk you're taking. So physical first, yes, and then equities. With regard to the allocation, I think an awful lot depends on a person's age and financial circumstances. If you're an older person with no financial obligations, you know, your children are all grown up and doing well and so on and so forth, you know, you can get by with a smaller amount of insurance, which means a smaller amount of physical. But, you know, if you're in your 40s or something and you've got obligations and you've got, you know, a house that you have to pay for and you've got children that need to go to school and college, you know, I think you need a higher amount of insurance. So there's no simple answer to that, I don't think.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy.
And for those who want exposure to the mining sector, as you were saying, it is very speculative endeavor, especially when you look in the junior mining space. But maybe someone wants exposure to that sector but doesn't have the time or expertise to properly evaluate individual companies. So for that type of investor, would an ETF that holds a basket of miners or perhaps the royalty and streaming model be an option for them?
Yeah, I fully understand the person that doesn't have time, because the mining sector is arguably certainly one of the most idiosyncratic sectors out there, by which I mean that even though circumstances are good and the average goes up, you will have some that way outperform and some that way underperform, which is not true. You know, if you want to buy food companies, for example, well, you could buy Danone and Unilever and Nestle and Mondelez, and, you know, one or the other will do better than the others, but you're not going to see one of them collapse by 50% while the other one triples. In the gold mining sector, you can easily see that. And in fact, I've done some studies on that. We don't have time to talk about it, but I've done some studies on that where, you know, picking senior stocks at random over a random period of time, over a year, so not just a short-term thing, you saw stocks triple, double, and other stocks down as much as 25 to 30%. So the discrepancy is huge. So for that reason, that's a preamble into saying I'm not a big fan of ETFs, particularly if the ETFs are market cap based. They pick stocks based primarily on market cap. Because in that case, you'd be buying the good, the bad, and the ugly. And as we both know, there's an awful lot of ugly in this sector as well as good. So I'm not a big fan of ETFs. There's a couple of firms. Sprott has a gold miners ETF, US Global. I don't know if you mind me mentioning names. US Global, and I have no interest in these companies. US Global has a gold miners ETF, which are both qualitatively selective on the stocks that they own, and those would be a little bit better. I honestly think if a person can do their homework, they are much better off doing the homework and picking their own stocks. There's no question that if gold goes to $5,000 an ounce, you know, the GDX will give you plenty of return. Thank you very much, no problem. But you'll do better if you can pick your own stocks, I think.
And any thoughts on the royalty and streaming model when it comes to gold and silver?
No, absolutely. I think the royalty companies, but the larger royalty companies we're talking about now, are the perfect vehicle for the investor but wants to be exposed to the sector but doesn't really have the time to devote to it. If you look at a company like Franco-Nevada, for example, $1.2 billion in cash, no debt, and plus $1 billion available on their credit line. So rock solid balance sheet, top management. They've got revenue coming in right now from over 100 assets. So very well diversified. Plus they've got about almost 400 undeveloped assets, you know, but in a strong market will do well. So the pipeline is strong. And I mentioned the statistics on Franco. It's the largest of the royalty and streaming companies, of course, because it does mean you get strong balance sheets and broad diversification. So yeah, I mean, if someone wants to just buy Franco, Wheaton, a Cisco, a Royal Gold and a Cisco, I think they will maybe not be the best performing gold investor in the world, but they sure won't be the worst.
Right, very good points there. And I wanted to get your thoughts on how you see silver positioned at the moment, because historically it tends to outperform gold initially in a precious metals bull market. Obviously, we're seeing a lot more use for it recently when it comes to solar panels. A lot of people have touched on that, as well as a lot of other green energy. How do you see silver positioned here in 2023?
Yeah, okay. Yeah, again, stepping back a second, you raised some important points. And it's not just the sources of demand that have changed, but it's also the sources of supply. You know, if you go back to the 70s and 80s, something like 75% of silver was from primary silver mines. Today, those numbers are flipped. About 70% of silver is byproduct. And it's not just byproduct of a gold mine, which wouldn't really matter if it was just a gold mine because they're both monetary metals, but it's byproduct of copper, zinc, lead, etc. And so that's really critical, because what it means is that the silver supply does not respond directly and immediately to changes in demand for silver, up or down. You know, if the demand for copper changes over a number of years, let's say it goes up dramatically, you would expect more mines, mine expansions, more exploration, more production. You know, the zinc miner in Bolivia or the tin miner in Bolivia is not going to increase its production of tin because there's a stronger demand for silver. And so both on the supply side and the demand side, the market is different from what it was 40 years ago, but it also means that other factors, industrial factors, play a much greater role now. Having said that, that can work to your benefit as well as your negative, because what it does mean is that in a slowing economy, when industrial demand is down and production of the base metals, other things being equal, forget the green for a minute, will be down, the demand for gold and silver as monetary assets can go up. So the demand for silver can go up dramatically in certain environments when there is no production response, right? And so I think this phenomenon that we've seen of silver dramatically outperforming gold in certain, sometimes only short term, but in certain environments, and maybe short term, I think that will continue. I think that will continue. We're not there yet, but I think we'll see that.
So aside from gold and silver, are there any other metals or commodities that you have your eye on at the moment that you're particularly bullish on?
Yeah, I'm looking at both the supply and the demand, because the big problem with demand right now, of course, is notwithstanding the new demand, dramatic new demand for many metals from the electrification. I think we all know, an electric car takes 5 times as much copper as a internal combustion engine, and so on and so forth. So notwithstanding that supplying a demand increase, if the global economy goes into a recession, then the traditional industrial demand for base metals will go down, partially or even fully offsetting the electrification demand. So I'm looking at things with a supply problem, if you want, as well as a good demand pattern. And to me, copper is the number one. Copper is far and away the number one outside the precious metals, not only because of the demand, we could talk about electrification, but also because of the supply. And the important thing for people to understand about copper is that even, you could get a gold mine of 100,000 ounces a year, which is reasonable, and they could bring it into production for $80 million, and they could do it in 2 or 3 years. With a copper mine, you're talking about $1 billion or $2 billion capital investment, and you're talking about a long period of time, forget about discovery, a long period of time from when you have a potential economic, when you have an economic deposit until it actually starts producing. And that period of time can be as long as 5 years. And because of that, we can be reasonably certain today, looking ahead to, 23, looking ahead to 27, 28, we can be reasonably sure what the potential supply in 27, 28 is. There is not going to be a significant source of copper in 2027 that we don't already know about today. Now, some mines might produce more than we were expecting. Some mines will have nice brownfields discoveries. Some countries could, miracle of miracles, some countries could shrink their permitting time and try to encourage copper mining, but you're not going to have a major source of copper in 27 that we don't already know about. And unless the world goes into a serious recession, it means we don't have enough copper to meet the anticipated demand, which means higher prices.
Yeah,
So I'm
great
bullish
points.
on copper. After
Yeah, completely
copper,
agree with you there as well. But we had Paul Harris on the show not too long ago who echoed your sentiments there.
yeah.
But please continue.
No, I was just going to say, other than copper, because copper is my number one, uranium, I think, is a story, but I'm not sure that this year or next year is necessarily uranium story. Having said that, we have to remember, I think as Rick Ruler likes to say, just because it's imminent doesn't mean it's, just because it's inevitable doesn't mean it's imminent. That's true. But if it's inevitable, at some point, you'll go from, oh, I've got plenty of time to, oh, I missed the boat. So uranium is one that we're building up. We're trading it a little bit, and we're sort of slowly accumulating positions. Silver, of course, we've mentioned. Those are really my main ones. I am not involved heavily in the rare earths and the lithium and all that kind of stuff. Other than, and this is important, it's just the way I prefer to do things, other than through my exposure, let's say lithium, to lithium through other companies that I like anyway. So Altius Minerals, for example, which is a pretty, you probably know it, it's a pretty diversified royalty company in commodities across the board, everything from renewables to coal. Although they're trying to get out of coal, but anyway, everything from renewables to coal and copper. But they participated in the IPO of lithium I forgot what it's called now. Oh my gosh, the one that came out last week. I'm sorry. Just had sorry. But they own about 10% of the company. They have royalties on some of their lithium projects. So I'm getting some lithium exposure through a company that I like anyway, and a company that's not going, a stock that's not going to blow up if the lithium doesn't work.
Great. Well, thank you so much for joining us today, Adrian. So much knowledge shared. I know viewers are going to get a ton of value out of it. For those who want to hear more from you, where's the best place to direct them online?
Yeah, it's adriandayassetmanagement.com.
Great. Well, I'll put a link to that in the description below. Hope to see you at next year's VRIC. That would be
Yep.
great. And
Hope
you
it's
have
not as
yourself a great
cold
day.
next year as it was this year.
Yeah, yeah. All right, Adrian. Talk to you soon.
Thank you so much. Thank you for having me.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.